1,045 tons vanished from vaults in 2024. Gone. The third consecutive year, central banks bought over 1,000 tons of gold. You know what else happened 3 years in a row? Russia's foreign reserves got frozen. $300 billion. Inaccessible overnight. November 2025. India just repatriated 100 tons of gold from the United Kingdom, the largest single movement since 1991. And right now, something's happening that reveals a pattern playing out across human history. 68% of central banks now store gold domestically. That's up from 50% in 2020. This isn't about gold going up. This is stage 3 of a 4-stage pattern that determines which nations survive monetary resets and which ones don't. And when stage 4 hits, the price won't be $3,000, it'll be $10,000 or higher. 3 times this pattern has destroyed empires. 3 times the nations who saw it early positioned themselves for the transfer of global power. 3 times everyone else stood there wondering what the hell just happened. By the end of this video, you'll understand exactly where we are in this pattern, why Germany is considering moving 1,200 tons out of New York, and what the freezing of Russian reserves teaches us about the death of reserve currencies. Let me give you the pattern. It's brutally simple. Stage 1, trust and centralization. Nations store gold in global financial centers. London, New York. Trust absolute. Convenience assumed. Everyone believes their reserves are safe. Stage 2, weaponization. A crisis hits, sanctions, freezes, asset seizures. The dominant power uses control of gold storage as a weapon. Trust begins to crack. Stage 3, the exodus. Central banks recognize the risk. They repatriate, they diversify, they buy more gold domestically. The feedback loop begins. Less trust, more physical demand. Stage 4, the reset. Gold's price disconnects from paper. The old financial centers lose their monopoly. Reserve currencies collapse or devalue massively. And the nations holding physical gold in their own vaults win. That's why location matters. When stage 4 hits, you don't want a promise of gold stored somewhere else. You want metal you control, in your vault, in your territory. And I'm going to prove to you using central bank data that we're already deep into stage 3. But first, you need to understand why gold storage became centralized in the first place. Because the system we're watching collapse was built on a lie. A convenient lie, but a lie nonetheless. For centuries, gold moved constantly. Trade settlements, war payments, diplomatic transfers. Heavy, expensive, risky. Then came the solution, or so it seemed. London and New York emerged as global gold hubs. The Bank of England, the New York Federal Reserve, they offered something seductive. Store your gold with us, we'll keep it safe. We'll make settlements easy. You won't need to physically move metal for every transaction. And it worked. For decades. By 1971, the New York Fed held thousands of tons from dozens of countries. The Bank of England the same. Trust was complete. Convenience was absolute. Germany stored half its gold in New York. Italy kept 1,061 tons at the Federal Reserve. Netherlands stored 38% in Canada. India held massive reserves in London. Why? Because the system worked. The dominant reserve currency was the dollar. The dominant financial centers were New York and London. And everyone assumed their gold was as good as in their own vaults. Better even. Cheaper storage. Easier transactions. Lower insurance costs. That's stage 1. Centralization built on trust and convenience. But here's what everyone forgot. When you give someone else custody of your wealth, you give them power over you. And power gets weaponized when crises hit. Watch how stage 2 begins, February 24th, 2022. Russia invades Ukraine. Within 48 hours, the United States and European Union freeze Russian central bank assets. $300 billion out of $640 billion. Gone. Inaccessible. But here's the critical detail everyone missed. Russia's gold, stored in Russia, untouchable. $130 billion in physical gold. 20% of Russia's central bank holdings. In Russian vaults, under Russian control. The West couldn't freeze it, couldn't seize it, couldn't weaponize it. So what did they do? March 24th, 2022. President Biden signs an executive order banning transactions with Russian central bank gold reserves. Not seizing the gold. They couldn't. It was in Russian territory. But preventing Russia from selling it internationally. Secondary sanctions on anyone who bought Russian gold. The message was clear. We control the financial system, and we'll use that control as a weapon. Now here's where it gets fascinating. Because Russia learned from history. Venezuela, 2011. Hugo Chavez repatriates 160 tons of gold from Europe. Prescient. Because when sanctions hit under Nicolas Maduro, that gold became his lifeline. He couldn't access dollars, couldn't access euros, but he could sell gold. Through Russian planes to Uganda, then to the Middle East. Sanctions evasion through physical metal. The Bank of England refused Maduro's later request to repatriate another $1 billion in gold. Frozen. inaccessible, political weapon deployed, and every central bank in the world was watching. This is stage 2, weaponization. The moment when nations realize gold stored in someone else's vault isn't really yours. If this is connecting dots you've never seen connected before, subscribe right now. Because what I'm about to show you about stage 3 is happening in real time. And the nations moving first are positioning for the wealth transfer of the century. Seriously, click it. You'll want to see what's next. Stage 3, the exodus has begun. Germany, 2013 to 2017. Bundesbank repatriates 300 tons from New York and Paris, quietly, methodically. But here's the number that matters. 1,200 tons still at the New York Federal Reserve. And in April 2025, Germany is reconsidering. Donald Trump's tariff wars, European political uncertainty. The Telegraph reports Germany is evaluating bringing it home. India, June 2024. 100 tons repatriated from the United Kingdom. First movement since 1991, then another 64 tons in the first 6 months of fiscal year 2024 to 2025. Why? According to Reserve Bank of India sources, domestic storage enhances operational flexibility, reduces exposure to external political pressures. Translation: we watched what happened to Russia. We're not waiting for it to happen to us. Nigeria, April 2024, repatriates gold from the United States, citing concerns over the U.S. economy. Poland, 67.1 tons purchased in 2025. Geopolitical uncertainty from Russia's war in Ukraine. Security concerns front and center, and the trend accelerates. A 2024 survey by the World Gold Council, 68% of central banks now keep gold on shore, up from 50% in 2020. That's not gradual diversification, that's a structural shift in trust. Because here's what changed. February 22nd. Russia's reserves frozen. Every central bank governor had the same thought. If it happened to Russia, it could happen to us. The risk isn't theoretical anymore. It's documented, verified, real. And when you realize your gold isn't really yours unless it's in your vault, you act. China, 22.7 tons added in 2025, on top of 44.2 tons in 2024. And here's the key. China doesn't store gold in London or New York. Never has. Domestic vaults only. Kazakhstan, 32.4 tons added in 2025. After selling 10.2 tons in 2024, reversed course completely. Turkey, steady accumulation through 2024 and 2025. Domestic storage, physical control. Czech National Bank, 30 consecutive months of buying, from 23 to 65 tons, targeting 100 tons by end of 2028. The pattern is unmistakable. Buy gold, store it domestically, remove counterparty risk, now add the numbers. Central banks bought 1,045 tons in 2024, third consecutive year over 1,000 tons. The 15-year average before 2022, 473 tons annually. This isn't normal. This is panic buying disguised as prudence. And here's the acceleration. First half of 2024, 183 tons, highest on record, 5% above the previous record. But it's not just emerging markets, though they're leading. 14 emerging market central banks moved reserves by a ton or more in Q2 2024. Developed markets? Only one, Singapore. The shift is clear. The global south is exiting the Western financial system, not loudly, not dramatically, through gold repatriation and domestic accumulation, because they understand the pattern and they know what's coming. Stage 4. Now, some of you are thinking, but America is different. We have the reserve currency. We have the strongest economy. We have military dominance. Let me destroy that delusion. Britain had the reserve currency. Pound sterling backed by gold. Controlled global trade for a century, then World War I. Massive borrowing. Gold standard suspended. Debt exploded from £650 million in 1914 to $7.4 billion by 1919. Tenfold increase. They tried returning to the gold standard at pre-war parity, but the money supply had expanded. Debt was crushing. Gold reserves bleeding. 1931. Britain abandons the gold standard. Pound devalues 25% overnight. Other nations dump pounds. Sterling block crumbles. Bretton Woods, 1944, makes it official. The dollar becomes the world reserve currency. The pound that once ruled the world? Just another currency. Same pattern, different empire. And here's where we are with the dollar. Post-World War II, America dominates global production. 50% of world GDP. Dollar backed by gold. Convertible at $35 per ounce. 1971. Nixon closes the gold window. No more convertibility. Pure fiat. Backed by nothing except confidence and military power. And America begins spending beyond its means. Vietnam War, Great Society programs, military bases in 130 countries, endless deficit spending. National debt grows from $370 billion in 1970 to $36 trillion in 2025. $36 trillion. Money supply M2 explodes from $600 billion in 1971 to $21 trillion today. 35-fold increase, but the world keeps accepting dollars. Why? Oil is priced in dollars. Global trade, dollar-based. No alternative. Yet. Until the petrodollar system starts eroding. Saudi Arabia negotiating oil sales in other currencies. China pushing the UN. Bilateral oil agreements bypassing dollars. BRICS nations building alternative payment systems. 40% of global population. 32% of GDP. Developing alternatives to the dollar entirely. And central banks buying gold at record rates. 1,045 tons in 2024. Diversification away from dollar reserve holdings accelerating. The IMF currency composition of official foreign exchange reserves data shows it clearly. Dollar share at 57.8% at end of 2024. Down 0.6, 2 percentage points year over year. Slow, but steady, and accelerating. Meanwhile, gold's share of official reserves, nearly 20%, up from 15% at end of 2023. The trust is breaking. The foundation is cracking. And that brings us to stage 4, the reset. I'm not saying the dollar goes to zero overnight. I'm not saying the United States collapses tomorrow. But here's what is mathematically inevitable. The dollar will lose reserve currency status, possibly within this decade, certainly within 2, and when that happens, gold's role transforms, from a percentage of reserves to the reserve itself. Because here's the mechanism. When confidence in paper currencies breaks, capital flees to physical assets, and the most liquid, most trusted, most historically proven physical asset is gold. Rome, 3rd century. Denarius debased from 95% silver to 5%. Hyperinflation, currency collapse. Those holding physical metal survived. Those holding coins, worthless. Weimar Germany, 1923. Mark collapsed from 320 per dollar to 4,200 billion per dollar. Those holding gold, land, industrial assets, they survived. Those holding marks in banks, obliterated. Bretton Woods collapse, 1971. Gold goes from $35 to $850, 24 times in 9 years. Those who positioned in gold before the reset, generational wealth. Those who waited, watched purchasing power evaporate. The pattern is absolute. When reserve currencies collapse, gold revalues. And right now, we're watching the setup in real time. Central banks buying record amounts, repatriating from Western vaults, storing domestically. They're not doing this for yield. Gold doesn't pay interest. They're doing it because they understand the pattern, and they know what's coming. JP Morgan projects gold at $3,675 per ounce by fourth quarter 2025. Some forecasts go to $4,000 by mid-2026. But that's short-term price action. Stage 3 pricing, momentum, trend continuation. Stage 4? Different entirely. Because stage 4 isn't about price, it's about function. When reserve currencies reset, gold doesn't just appreciate, it revalues to reflect its role as the settlement mechanism for international trade in a post-dollar world. What's that level? Some analysts say 7,000, others say 10,000. Jim Rickards has argued for 15,000 based on backing a portion of global money supply with gold. The exact number is unknowable, but the direction is certain, massively higher. Because when central banks control 37,755 tons of gold, and that gold becomes the primary reserve asset backing global trade, the price adjusts to reflect that function. $10,000 per ounce, conservative in a stage 4 scenario. So here's what aware people understand. First, this is not investment advice. I'm not a financial advisor. Do your own research, consult professionals. But if you understand the pattern, here's the positioning framework. Diversify out of pure dollar exposure. Not entirely, but meaningfully. 10%, 15%, 20% of assets. Hold physical gold, not paper ETFs, not futures, not certificates. Physical metal you can hold, coins, bars, allocated storage you control. Why? When stage 4 hits, when confidence breaks, you don't want counterparty risk. You want real assets. And understand this, the repatriation trend tells you everything. When central banks with unlimited capital and inside information are moving gold home, they know something. They're not speculating. They're not predicting. They're recognizing a pattern and positioning before stage 4 arrives. The 68% storing gold domestically, that's not random. That's risk management by the world's most sophisticated financial institutions. They watched Russia, they watched Venezuela, they learned the lesson. Physical gold in your vault is yours. Gold in someone else's vault is a political weapon waiting to be deployed. And the exodus accelerates. Germany reconsidering New York storage, Poland buying aggressively, India repatriating continuously, China, Turkey, Kazakhstan building domestic stockpiles, even El Salvador adding gold for the first time in decades. The pattern is unmistakable. The direction is set, stage 3 is active, stage 4 is inevitable. The gold repatriation movement isn't a bull market, it's a warning signal. It's the canary, and the canary is flying home to its own cage. If this opened your eyes, subscribe, because next video I'm showing you exactly how the BRICS nations are building the alternative system that ends dollar dominance, the gold-backed settlement mechanism, the commodity basket approach, the bilateral trade agreements bypassing dollars entirely. You need to watch that, because the $10,000 gold reset isn't speculation. It's the logical conclusion of a pattern that has destroyed every reserve currency in history. The difference this time, you're watching it happen. In real time, with perfect information. The question isn't whether stage 4 arrives, it's whether you position before it does. The central banks already made their choice. They're repatriating, they're buying, they're storing domestically. What's your choice? Thanks for watching. See you in the next one.